When you try to move capital quickly across borders, you are immediately confronted by the sheer weight of legacy financial infrastructure. For the African diaspora, this weight translates into a strict operational penalty. Sending money home through established corridors means accepting high overhead fees and waiting 3 to 5 days for a simple transaction to clear. The delay exists because fiat capital must route through a labyrinth of legacy correspondent banks, with each intermediary demanding a toll and processing time. On the left, standard US to Nigeria wires accumulate delays at every node. Neobanks replicating this hit a wall, forced to maintain massive Tier 1 capital and complex compliance. On the right, a blank canvas allows a completely new structure, a virtually integrated innovation engine. By entirely offloading the actual banking operations to a banking-as-a-service partner, a fintech platform can bypass structural latency completely. For Sigma Bank, achieving this requires a specific architectural separation, a two-engine model. Eliminating remittance latency requires physically severing the traditional finance plumbing from the high-velocity Web3 technology layer. Every financial ecosystem needs a tether to fiat liquidity, which requires an onshore, strictly regulated foundation. Here is the blueprint. It begins with a solid structural base, Grasshopper Bank acting as the onshore TradFi engine. Their banking-as-a-service APIs plug straight into the Sigma foundational layer. These APIs manage account creation, international USD custody, and foreign exchange wires, all occurring completely within regulated boundaries. Relying on an FDIC member institution with a well-capitalized regulatory standing is a mandatory requirement to handle the complex risk and compliance management that global finance dictates. This integration also establishes an immediate operational cost-saving mechanism. Using Grasshopper's rails allows for zero-fee ACH and domestic wire transfers for balances over $25,000. Embedding a regulated API at the structural base neutralizes the compliance and capital burdens that typically throttle the scaling velocity of early-stage neobanks. To maintain this clean regulatory profile, the upper Web3 layer must operate under a strict constraint, the no-leverage rule. Sigma positioned itself strictly as a non-lending entity. It never holds credit risk on its own books. When a user requests venture debt, the data hits a central decision node and is aggressively routed downward, passing directly into the Grasshopper TradFi API block. Because the chartered institution originates and holds the actual credit, the upper Web3 layer remains completely insulated from default risk. The specific servicing and collateralization of that loan can still be managed on Web3 rails, even while the core debt sits securely inside traditional finance. Offloading the execution of credit to regulated partners means the platform doesn't need to hold massive reserves. The Tier 1 capital constraint becomes an irrelevant metric. With the regulated fiat foundation locked in place, we can introduce the frictionless velocity of the technology layer. This is the Sigma engine, the Web3 innovation layer, entirely freed from fiat compliance burdens. Returning to our blueprint, this transparent Web3 grid locks into place directly above the TradFi base. An automated pathway draws inbound fiat liquidity up from the Grasshopper API. Those fiat dollars entering the grid are immediately minted into Alcoin, a tokenized deposit representation. These tokenized deposits act as a programmable medium of exchange. They bypass the 3 to 5 day waiting periods of corresponding banking entirely. This structural efficiency is the specific mechanism that allows the platform to offer its primary growth metric, a zero-fee freemium remittance service. Tokenized deposits provide the engineering framework required to achieve zero-latency value transfer across the US-Nigeria corridor. This architecture presents a secondary challenge. If a bifurcated neobank refuses to engage in predatory lending, how does it generate yield for its ecosystem? Traditional banking models extract yield through debt-based interest. Web3 replaces extraction with participation. Instead of lending out deposits, users deploy their assets into staking protocols, generating yield through liquidity provision and network security. However, a major psychological barrier prevents diaspora users from fully adopting staking, the systemic fear of token volatility or smart contract failure. Users can upgrade from a freemium tier to a premium tier, wrapping their tokenized assets in a protective shield of smart contract and deposit insurance. This golden rider is underwritten by partners, ensuring the digital assets are protected against protocol failure or depegging. Offering an ironclad insurance rider turns the Web3 platform into a safe harbor. It functions as the primary stickiness factor for long-term user retention, bridging the trust gap entirely. Zooming out, we can now evaluate the completed, fully integrated system architecture. This model systematically disarms 3 fatal constraints destroying early-stage fintechs. The TradFi API foundation block satisfies regulators with chartered compliance. The strict no-leverage rule isolates credit risk, eliminating massive capital reserves. Finally, the premium-tier insurance shield secures deposits, building trust. TradFi delivers the fiat plumbing and the guardrails, while Web3 delivers tokenized velocity and yield. By specializing each pillar, compliance in one, velocity in the other, the system scales without the friction that slows down global fintech. Offloading the heavy regulatory and capital requirements of lending allows the ecosystem to focus its resources on expanding high-utility DeFi services for the diaspora.